Hello and welcome to our summit session on machine learning and high-value payment systems, uncovering patterns, hunting for anomalies, the academic research. I'm Ann Butler, and I'm the moderator of today's session. I'm thrilled to be introducing today's speakers, Segun Bewaji from Payments Canada's research team, and Simone Giansante from the University of Bath. Segun and Simone will be introducing us to new ways to assess and analyze risk on high-value payment systems. We don't have a ton of time for this important topic, so we'll get right to it. The way this is going to work is Segun will start, he'll present his work, and we'll have a very brief period for questions. Then we'll turn to Simone and do the same thing. So over to you, Segun. Let's hear about detecting outliers in high-value payment systems using neural networks. Over to you.
Thank you, Anne. So this is work we've been starting with our colleagues and counterparts at the Dutch National Bank, trying to really see if we can improve identification of anomalies in high-value systems. And the main motivation for this is really sort of comes from the PFMIs. So those are the principles for financial market infrastructures. And the view there is, payment systems operators should be able to not only identify but understand the issues and sources of risk within the systems, and these could be liquidity risk, operational risk, cybersecurity, systemic risk. But it also helps us, think forward towards fraud detection in real-time payment systems as well. And work has been done in this field in using machine learning in the financial markets, or stock price detection, and fraud, credit card fraud detection as well. Next slide. So our research question is really one of, can machine learning algorithms, specifically autoencoders, which are essentially neural networks with memory, can these actually help us identify and understand the sources of risk within the system, and also improve on existing literature in the field of the application of neural networks to payment systems. So going to what the previous research has done, well, I guess I'll start by explaining what an autoencoder is and essentially what it does. So it really is nothing more than a mapping tool, if you will, to map a set of input vectors. So this could be in our field, this would be payment data, bilateral and otherwise, and mapping those to output vectors, which would be other payment flows and information. And what we're really interested in, and what previous research has been interested in, is really trying to understand that hidden layer in between, that layer of functions that actually does that mapping for us, and get a better understanding of what's actually going on there. So and really the outputs of these approaches would be really to categorize payment flows. So bilateral payment flows, sort of trying to identify them or categorize them into clusters based on, very certain characteristics of those payments and so on. So this would be the ideal sort of layout of that, where you could actually say, this payment in this cluster represents this particular issue or source of risk or something. Moving on. But one of the, I guess, problems with autoencoders is that while they're great and they're very useful, they lack history. And by lacking history, that means they're sort of losing information about pre-existing patterns in payment flows between individual banks and so on. And by also doing that, you're just losing a lot of data in that analysis. So what we are hoping to do in the research is really bring in memory. So, we're able to capture those past patterns and relationships between particular institutions. And from there, try and understand, based on these patterns, what are anomalous in there. So just a brief overview of what an long-term, short-term memory is, or LSTM. It's essentially the bringing that memory into the pre-existing autoencoder. So if we look at this chart here in the blue, what we see is the initial autoencoder, which would be the bottom part of the chart, is essentially the old neural network from previous research, taking in the payment flow data across predefined windows and making predictions, which would be the input vectors leading to the output vectors, if you will. But what we're doing in this research is adding additional layers on top of that through what are called gated recurrent units, I'll just call them gates going forward. But essentially, we're adding these gates in to, one, account for memory. So that is taking predictions from the past, collecting those, and applying on-off rules, if you will, to them to determine how much of that information we choose to remember and to what extent we choose to attenuate that memory as well. So it's almost bringing the human memory process into the system. Also, because we need to separate going forward into further time steps, we need to separate what are memories from what are new predictions. We add another gate to that, which helps us filter that out, and that's the selection gate, which is this the topmost gate, if you will. And again, like I said, that just filters out the memory from the new predictions. Finally, we have a gate which helps us remove irrelevant information from the prediction. So these are predictions that are generally just wrong or just noise. So we want to remove those. And what should be noted here is that each of these gates and even the original autoencoder all represent neural networks of themselves. So what we have here is not just one neural network, but 4 neural networks operating at the same time. And that actually adds a lot more complexity to that hidden layer in terms of trying to actually understand that. So there's a lot of compute involved in that. And just to put these in clean sort of mathematical form, each of these equations essentially represent that system in that diagram I walked through in the previous slide. And I won't go through each one, but essentially each equation here represents a gate. And the sigma terms are really how we, because like I said, there's so much compute involved in the actual neural network. We need a way to sort of condense that information down so that we're not eating into too much compute resources. So we have these sigma terms here to actually act as sort of compression terms, if you will. They're sigmoid functions. They really just limit the range of outputs to 0 or 1 or -1 and 1. And every piece of information in the predictions will fall within those range, determining on what sort of function we use for the sigma. The sigma. Moving forward, the data is essentially the bilateral flows between individual banks in the systems. So here we're looking at both Target 2 and LVTS. And one of the reasons we're doing this is really to understand not just, how can we identify risks within each system, but also what are the differences in design, in the design language of both systems that would potentially lead to differences, if you will, because in theory, identical systems should be able to sort of identify the same patterns, if you will, but system design might play a role in the differences between them as well. But essentially, they're bilateral flows, and along the diagonal, these would be zeros because we assume that no bank will send payments to itself, essentially. So there. Moving on to scenarios we're hoping to look at. These ideally will try and capture all aspects of, or as many aspects of, the motivations that I mentioned earlier. So in terms of liquidity, risk, we're looking at intraday liquidity crises, scenarios to sort of capture those, and bank runs. We're looking at operational outages as well as part of this. And as I mentioned earlier, also the differences between the two systems in terms of their design language as well. So the challenges in this research, as I guess the biggest one, as I mentioned earlier, is the amount of compute and just the amount of data that is created, because we're not interested in the output layer. So usually in a neural network, you're trying to predict something. In this instance, we don't really care about the predictions, because what we're doing is we're taking input data, we've created output data that has anomalies in them, and we're trying to understand how we go from those inputs to the outputs. So we're interested in the hidden layer, and the hidden layer has a lot of information in there that we have to pass through and sort of make sense of. So even though, you can have 7 banks, you reduce it to the larger 7 banks in the LVTS or target 2, for instance, you're still ending up with a large vector of data that you need to sort of condense and categorize and make sense of as well. So this is essentially one of the biggest challenges we have in doing this. So going to the results, what we have right now, this is our benchmark, this slide, and essentially, as I showed earlier, the ideal outcome would be, the algorithm is learning something and categorizing payment flows into different buckets and separating them across range. And what we're finding is, certainly with respect to the LVTS, as we're still waiting for the data to finish running for target 2, with the LVTS, we're not really seeing any categorization. So I'm hesitant to say it's not learning, but it's not showing any signs of the payment flows being any different, if you will. So, and this is based on the day of the month as well. So we're not separate. It's not able to identify a specific day of any specific month in any way, shape, or form to be different from any other same day in any other month. So this is the basic autoencoder. If we move on to the memory autoencoder, it's pretty much showing the exact same thing as well. And one of the sort of questions this raises is, we know the LVTS, for instance, is an internal liquidity generator. So this might just be a case of there might not necessarily be any reason for banks in the LVTS to behave differently on any particular day, because there's a lot of liquidity in that system. So we would need to sort of compare this to what's happening in target 2, where there's a lot more sort of hands-on management than you necessarily will see just because of the design nature of the LVTS. But like I said, we're still waiting for our colleagues or counterparts at the DNB to finish processing their network. And so, yeah, so this is essentially where we've come to so far. The next steps would be, like I said, trying to see what the differences between the algorithms in the LVTS versus target 2, and also look into different ways to sort of visualize this latent space, if you will, which is essentially that hidden layer, because what we might be doing is one particular algorithm which helps to visualize that space might not necessarily be picking up something that others will. So we're going to look into sort of different algorithms to try and get a better sense of what this hidden layer actually looks like across multiple algorithms, and possible research into finding other ways to transform the data, because we might not need to use bilateral flows. We might need to transform that data into some other way to represent that flow and feed that into the networks as well. So there's sort of a lot of work ahead of us in terms of this, but this is essentially where we are. And with that, I'll open up to questions.
Well, thank you, Segun. A really great overview of this important work in progress, and we're going to look forward to seeing this combined with the data coming out of your colleagues in Europe who are also working in this respect to Target 2. A question from the audience, maybe to pick up on and combine with one that was in my mind, is, you showed the distribution from some of the work that you've done so far. How would you actually detect an anomaly in the information that you're crunching, and what would you consider to be an anomaly in that data? How would you see it, and what would that be in your estimation?
Okay, so because anomalies are very they've been rare, so we've had very few operational outages relative to just how long these systems are active and live, even over the course of any day. And over the years they've been active, it's very difficult to actually identify anomalies within the flows themselves. So one of the things we're doing is, using expert knowledge to define anomalies. So this is earlier when I said that we weren't interested in the output layer, in trying to predict the output layer. That's because we simulate the output layer. So we have a sort of expert input into what might an outage look like. So an operational outage or a cyber outage, what might that look like in terms of flows between individual banks? And we're seeing if, with the input data, which we haven't changed, can that map to the data that we're using as the output layer, which is the original data, but transformed with expert information as to what those anomalies might look like, and then trying to get a gauge of what is actually going on in the hidden layer in the middle. So essentially we are defining what those anomalies are, and getting our colleagues in the products or operations and others to actually give us a sense of what those outputs might look like in terms of the anomalies.
Thanks. Simone, I know you had a couple of questions for Segun, so I think I'll turn it over to an expert to ask the next question.
Thank you very much, Anne. Thank you, Segun, for the very interesting presentation. Fascinated by those learning techniques to unravel the complexity of the data. I have a few questions on the technical aspect, but I'll focus first on the more general, and then if you have time, we can move on the more technical one. But I was curious to see no seasonality effect, no difference across different days of the week and of the month and across months, because usually in payment system you're expecting some seasonality effect. But then I realized that you are targeting anomalies, right? So your output are anomalies. So probably anomalies don't follow seasonality effect that you usually expect, which is fine. And then this is bringing me to whether you have looked into, for example, differences between target 2 and LVTS? Because at the end of the day, we are looking at some anomalies could be driven by some financial market infrastructure feature, and there are differences between the two systems. So I was curious to see whether you thought about or you have any comment on these aspects. Thank you.
Yeah. So seasonality, we didn't actually think about that. So that could be something we take away and sort of bring into the model, and that goes to what I mentioned about transforming the input data into sort of a different data set, if you will, where we might be able to bring those seasonalities out of the data, because right now it's just payment flows, and it could be we're not accounting for the difference in volume or value in particular points during the year, which there is evidence of that in LVTS. So so we haven't necessarily accounted for that yet. So that's something we'll definitely look at. In terms of the question on the differences, that's actually what we're hoping to identify as well, which is why we're working with the DNB in terms of seeing, what behavior in target 2 looks like, what behavior in the LVTS looks like in terms of these anomalies and so on. And to that end, even because we're moving from LVTS to links, we need to understand what that move might look like in the future. So target 2, probably the closest thing to the future link system. So having an understanding of target 2 behavior in there and how that differs from LVTS might actually help us better sort of plan ahead in terms of things to look out for, if you will. So that's where we are.
Thanks a lot.
A couple of other questions from the audience, Segun, if I can turn it again. So the question, the next one is around, you've looked at bilateral flows. Are you thinking about looking at multilateral flows in the future? And does that mean, is there significantly higher compute needed to do that kind of work moving forward?
I think so we haven't discussed multilateral, that's actually something we need to look at, actually. The more I think about it now, we do need to look at that, because again, that points to the liquidity savings mechanisms and the differences there. So, like I said, LVTS is internally generating liquidity based on the bilateral credit limits and how they work. And target 2 is your traditional queuing mechanisms and other things to generate liquidity, or at least save liquidity, if you will. So this is liquidity generating versus liquidity saving. And, the multilateral flows might actually help identify the performance differences in those approaches as well, which, may be useful down the road. So yeah, that's a very good question, actually.
I love it. I love it when you workshop these kind of papers when they're in progress, because you do get the benefit of the questions like Simone's and folks on the call today to ask some more questions that help us think about the future of the work. So another question, Segun, you talked earlier about how this kind of learning might inform future use cases of this kind of work. So there's a question related to, sort of anti-money laundering, anti-terrorist financing, and whether or not this kind of learning model could be in the future used to be looking for those kinds of behaviors on the payment system.
Yeah, it comes down to the data we get access to, or whoever uses these approaches has access to. So and it also depends on what you're looking for. So it might be easy to identify, money laundering and terrorist financing with these systems based on the networks that are created, because essentially, but payments are essentially networks of contracts that people engage in, and being able to identify in some way, shape, or form the sort of typical end sort of points in terms of, because right now we're looking at just the network within the payment systems themselves, but we also have, as Simone will go into in his presentation, you've got the second layer of institutions there, and if suddenly you've got a relationship that's built up over time of a payment going from, say, bank A, or C to A to B to D, and all of a sudden that changes to E, then that might be something that helps you, identify if funding is going towards terrorism or something, and money laundering and other things. So it is useful, but it depends. It comes down to the amount of data you actually will have access to in that situation. So
I know Simone had another question for you, so I'm going to throw it over to Simone.
Very, very quickly. One on the technical aspect, just a quick comment. These models are becoming more robust and better to deal with the complexity, regardless of the initial conditions that you set up when you start the training. So I'm just wondering what's any comment on potential sensitivity to the initial condition that you may have in your machine learning approach, and if there has been anything that you have solved over the time, because it's useful for people like me that want to implement some methodology like that.
Yeah, so I was actually speaking with one of the colleagues here at Payments as well, she's been working on the coding side of it with us, and the more technical side is our data scientist, and that was a conversation we had yesterday actually, in terms of going into the sensitivity analysis, just getting deeper into that, trying to understand why we're not even, for instance, why we're not actually seeing any difference between the basic autoencoder versus the LSTM, for instance, and just adjusting things there potentially as we go further along. So the sensitivity analysis is definitely something we are looking to do.
Well, thank you, Segun. And maybe with that question and answer, I will turn it over to Simone to talk about your work, Simone, on the de-tiering and the large value payment systems in Canada, which is a really interesting and informative piece of work that's highly relevant as well to our new payment systems that are being implemented this year. Thank you.
Thank you very much, Anna, and thank you for having me. I'm very excited to talk through this study that we started a couple of years ago with Payments Canada on the topic of de-tiering. Now, having listened to Segun talk about the complexity of the payment system as it is, you may think that it's already quite complicated. But now that we look at the second tier of some of the highly tiered payment systems, where only a proportion of banks are actually direct members of the system, they can actually send payments via the large value payment system. All the other banks have to have agreements with those direct members to settle payments. Complexity goes even increase even higher. So, and this is what basically our interest is. I have a very quick slide about myself. I'm from the University of Bath, and I've been studying payment systems since my PhD. And another very tiered payment system is the one in UK called CHAPS. And one of my chapters of a PhD was based on that. And this brought me to learn a bit of how a payment system was, RTGS versus NDTs, and what we can learn from a structure perspective. During my training, I've learned a lot about network analysis to look at the flows, basically the same structure as the one that we saw from Segun's presentation. In our case, we our objective is to uncover missing information, specifically between the first tier and the second tier. In the event we implement, or we propose an implementation of a system where everyone will be a direct member, and that will be the equivalent of a fully D-tiered system. We'll get to that point once I mention the model. Now, a motivation is straightforward. Tiering participation is an important element for consideration within the principle for FMIs. There are several elements of tiering participation that are of interest and mentioned in the principle 19. Three I've highlighted, specifically the third one, which is actually the encouragement of direct participation. There is a school of thought that assumes that the tiering system will always bring benefits, will reduce risk, will increase transparency, which is true, and provide more information, access to more information about the payment, which is actually true. But there is much more to on stake when you propose a new infrastructure that is going to change the current structure of how payments are settled. And because we don't know exactly what the new system will look like in a fully D-tiered system, where instead of having two tiers, direct members and indirect members, we have only one tier where everyone is a direct member. Everyone can settle payments directly. And this is what we are trying to study in this paper. We're trying to shed a light of pro and cons of moving towards a fully D-tiered system. We are starting touching on issues related to credit and liquidity risk that could be a consequence on moving towards a fully D-tiered system, which I will talk about in the very last slides. In order to achieve this goal, we approach the problem in the following way. Thank you to the available data from Payments Canada, especially two important data sets. One, which is pretty much, I guess, similar to what Segun has used for his work, specifically for the Canadian payment system, LVTS. So we have we use daily data on among the direct participants, but then we also use an additional set of information, all proprietary, of course, at the semi-annual frequency, where the largest, the first direct members share with us regarding the indirect member that have an agreement with them. So we kind of know the relationship between the major direct member and the indirect members. We pull together this information and we develop it's a sampling technique that follows many machine learning tools that tries to understand the initial payer and the final payer of each transaction. That in a tiered structure has to follow different steps. Okay, and I will get to that in a point. So we can generate solutions of D-tiered structure from a tiered initial set of data, and then we approach that by looking at changes in the structure and eventually looking at potential risk or unwanted outputs that we can observe when D-tiered at the network. So very brief findings, just to spoil the final part of my presentation. Of course, we observe some of the known results that we expect when we D-tiered a system. We see a lower concentration and dependency across the network because we unpack the flows towards only those few direct members across all banks. Okay. However, we start observing the emergence of some topological properties of the network that may raise issues in terms of stability and resilience. One of which would be clustering and the amount of core and central banks in the system that could lead to systemic consequences like systemic risk events in case they are under distress. Okay, and we will compare that later on. So at the end of the day, my final talking point will be: we have to be careful when we propose a system. We have to assess all potential consequences and try to investigate time and spend time and resources to gather more information that can limit the uncertainty. Okay, because there is a lot of money at stake. A lot. It's the payment system is a backbone to the functioning of an economy. We have to be careful when we propose any important structural change. All right, I will skip this part. We are going to talk about, so we touch on several literature strands, one that are on payment system, and the literature here is basically mainly for the Canadian payment system. The issue of tiering, and there is also a paper of mine that was my one of my chapters of PhD done in England with the Bank of England, and then some of the techniques we use from machine learning literature, sampling solution literature to propose solution to missing information. Okay, and this will become very clear in a second. Okay, so I will go through these steps. We'll talk about the data that we have, which is basically what I've just said. I'll talk about the methodology, how this data is used, our assumption, how to move from payments data to constraints in our payments network assessment, how the algorithm works, and how we can validate this solution that would propose a D-tier structure. And then we'll look at very preliminary results about risk as well. All right. So again, I think these I've already said that the two set of data. One is the LVTS data is an high frequency, is daily of payments between all members. We have 17 members, part of the as direct members of the system. We have all payments at the daily basis between them. On top of this data, we have the tiering participation reporting, where the top 5 direct member provides information about all payment received and originated by their direct member, all the direct members that are associated with that specific direct member. We combine the two to provide our set of constraints for the network reconstruction problem. Okay, so this is a visualization of what the data can give us as an information. So you have the blue area here, where between A and B are 2 hypothetical direct members. Okay, so all payments between direct member will be collected from the LVTS daily data. The tiering participation reporting data also provides information about all payment received and originated by indirect members that are connected to a direct member. So for example, C is a direct member of Bank A, which is a direct member. C has to go via A to send payments. Okay, so A will report that among all his 10 payments that go out, 3 are from C, and vice versa. From the 12 that is receiving, 4 are going to C. Okay, so we understand something about that, but we don't know where, for example, the 3 payment from C is going to, because it can go all to B, it could go to all to D, or partially to B and D. For sure, it won't go to A, because any payment between an indirect member, its direct member, will be internalized. That it doesn't have to go via the payment system. Okay, and this is what we call internalization of payments. And also, if A has more indirect members as part of his sub network, let's say NF, payments between indirect member of the same direct member are also internalized, because it's all done by the unique direct member that deals with all these payments. So we have a set of payments which may be quite high in volume that is missing from the data that we have, and we have to acknowledge that. If I have time, I will talk about that towards the end. But if we take out the internalized payments, the rest of the payment that went through the payment system, either originated by a direct member or by an indirect member via direct member, are there, and we can do something about it. We can try to understand and try to answer the question whether this amount 3, for example, from C is going to B to D or between the two of them. Okay, this is what we call a fully D-tier system, where everyone is a direct member. There are no indirect members anymore, so we can actually observe the initial payment and the final pay of a transaction. At the moment, we cannot, because the information is hidden within the chain of payments that have to go via the direct members. I hope I clarified this important point. Okay, so this example here, the 4x4 system can be represented in a matrix notation, and this is what we call a tiered structure. So we know all the payments that go from a direct member to indirect member following the tier structure. Our objective is to de-tier this network. Okay, so we have to take out the payments that are originated and received by and from the indirect member, and try to assess where this money is going to or is coming from as a first step. So we have to move from a matrix like this to something like this, where we have some missing information. We don't know. We know by this data the row and column sum, which means for all banks, direct and indirect member, we know all the payments that they send and they receive. What we don't know is the bilateral positions in a fully D-tier system. Okay, when we take out the chain of tiering, basically. Now, how do we achieve this? At the moment, we've proposed a two-stage estimation. In the literature, there are a lot of algorithms that can solve this problem when you have a row sum and column sum, and you have to balance basically this matrix with bilateral value that are consistent with these two constraints, row sum and column sum. For us, this is not enough. So we need a second stage to make sure that internalization is taken into consideration. Basically, the tiering structure is taken into consideration. So we have to superimpose some zeros in the network, because we know for sure that C, let me go back, there shouldn't be any payment from C to A. Likewise, D to B in the data. So we have to superimpose some zeros that are coming from the tiering structure. So this is the second stage, where we try to rebalance the network using some algorithms. We use the generalized RAS. It's a scaling algorithm that tries to rebalance it once we impose. So our first guess will be the one that comes from stage 1, and then we do the stage 2, and then we do some validation. We're able to achieve very good results with a very high accuracy by using these two-stage estimation. So these are 3 examples. So these are 3 examples that are solutions that are exactly consistent with the constraints. Okay, we don't know which one is the correct one. That's the problem. So when you de-tier the system from a matrix like this, that was the original one, you can end up with any of these 3, or even more, because these are just 3 examples. And these 3 potential solutions of this problem have inherited structural differences. Okay, and we'll see what we mean by structural difference. Just to give you a taste of what we can learn. These the first solution A has a decent payments between these A and B that are the original first the direct members, and decently balanced among direct and indirect, direct and indirect, which is the top right quadrant and the bottom left, and some payments between 2 indirect, C and D. However, if you move to B and C, B, for example, amplifies the payments between A and B, as well as between C and D, and minimize the payments across direct and indirect member. Complete opposite can be observed in C, where the payments between the top 2 banks, A and B, are minimized compared to the other, and we have no payments between indirect members, but we have a lot of payments across different types. Okay. And again, we don't know which solution is the right one. That we need to assess any potential consequence and make sure that we are ready to consequences that can arise from a particular structure that will become be the right one. Okay. So we use the data as I show. So this is what it looks like, the tiering structure. So we here in the center, we have in a circle, like we have these big 5 that are reporting the indirect member. In the center, we have the other 12 direct members, and at the edge, we have all the indirect members that are connected to the system via the direct members. Okay. So see, for example, number 56 bank. I don't know if you can see it. It's at the top. It's just below 2018. It's a very marginal bank. On the top right of these plots. When we detier the system, let's assume we assume on top of other assumption that we make, we assume that we have a low density. So we have low amount of payments, high volume, high value, lower volume of payments. This is one assumption that we can make, just because this is in line with the techniques that we are using. 56, which is here, I don't know, you cannot see, but 56 become quite a well-connected node, which we didn't know that it was until we approached that. Okay. What happens if we assume that banks have more counterparties to send payments to? So we increase the number of payments, so the density of the network. We take out a lot of zeros that we are allowed to. Then the networks start changing. So this is the plot for a medium density, and this is the top one. I forgot to mention that this is for the first semi-annual data Q1 and Q2 of 2018. This is just to visualize, to give you a visual understanding that you will be looking at the completely different structure that are all consistent with the initial constraints. Okay. Now let's look at some properties of the network. We have few basic that are reasonable for payment networks. One is called dependency. Dependency measure the average market share of the larger pay. Okay, and then we do the same for the payer later on. In all these plots, the single red dot is the property of the tiered structure, the structure that we have observed. And all the blue dots are all potential solution, de-tiered solution of the same tiered network. In this case, we are playing with the density, but we can play with many other characteristics. It's just a first approach that we did. Okay, so of course, de-tiering the system, we are taking concentration out of the few direct member. The dependency matrix goes down. It's a little bit of a non-linear relationship across density, but this is what we expect. Okay, the tiered network has an 85% dependency, which is quite high, which is consistent with the tier structure. When you're de-tiered, it goes down to values between from 60 to 42, 43, which is what we expect. Same for the payment that we receive, so the larger payer, similar thing. We can do the same for concentration, and again, concentration is basically the Herfindahl index. It captures a similar aspect, how concentrated are our payments across specific banks. And of course, the de-tiered solution are well less concentrated than the tiered one, okay? From 78 to 25 to 30%, which is reasonable. This is what we expect when we de-tiered, okay? The same for payer and payees. What happens when we look about clustering? And clustering is how many triangles we have in the network. So if I am a bank, I'm connecting with two other banks. What is the probability of these two banks are connected to each other? This is a triangle. Triangle can be a source of instability when there is a chain of reaction in one of the banks in the triangle defaults or is unable to send payments. It can trigger a chain of reaction within the triangles. This is something that we have to be careful, because the tier structure will bring up tiering, because clustering, because clustering is very low in a tier structure, just because of the tiering structure itself. Assortativity is something as well, but not. I will skip that. I will just focus because I'm running out of time. We can look at the amount of collateral pledged, so amount of collateral that the banks would have to take. And this follows the single largest exposure rule. In a tier structure, you have few banks that pay a lot because their limit is very high. However, in the D-tier structure, each bank will pay less, but the sum, because more of them will have to pay because everyone is a direct member, is kind of. But the difference are not that's huge. The only thing that I would like to, before I conclude, is about risk, and this is a matrix that is called sync rank. It measures the magnitude of disruption of banks in case of a liquidity disruption. Okay, if a bank cannot settle payments, what is the disruption in percentage? Okay, so the value at the horizontal axis is the percentage, and then you have two examples. One is a tiered one, and one is a D-tier one. This is one single example. Okay, I picked this one in particular because it's raised the question of a potential source of instability. So when you have a tier structure, you have a peak across the first direct members, which is the peak at the value of sync rank, which is across 13-14%. So if each of them defaults, unable to settle payments, it will cause on average 13 to 15% liquidity issues to the system. Okay, when you detiered, the average value moves to the left, which is good. On average, all banks will be much less disruptive if they default. However, have a look at the few banks that are on the right tail of this blue distribution. There are cases where few banks are even more dangerous in a D-tier structure than in a tiered one. Okay, these are cases that we observe in the data when we discuss, and these banks will bring up to 3 times the disruption that a single first direct member in the tier structure could pose to the system. Okay, and this is just scraping the surface of this approach. Just to conclude, this is something that we have learned. Just to conclude, and I will leave. I will open the Q&A section after that. Is that we have to be careful. There is a complex task to deter the system. There are good consequences out of it, but you can end up with unwanted consequences, like what we observed. And there are ongoing work that we are doing to improve this part, but this is the main message that I wanted to deliver. The structure may change in a way that you may not want to. So we have to be careful with that. Thank you very much, and if you have time for questions.
Fantastic, Simone. I think we're just about at time. I meant, Segun, if you could get a 30-second question in, then we're going to have to wrap, I think.
Sure. So, thanks again, Simone. You mentioned clustering and the tail risk of a few banks that may not have been actually important in a tiered system suddenly becoming very dangerous to a D-tiered system. Would there be a way to actually sort of, and this might go against sort of principles of the PFMI, but is there a way to actually using other techniques? Because you had a slide there that you sort of rushed through on the systemic implications of a particular institution. Is there a way to actually potentially identify institutions that you don't want to deter in any, regardless of the density of the network once deterred?
Yeah, of course. Yeah, thank you for the question. Just very brief. Yes, we can. This sync rank is one of few stress tests that we can run. We can assess the probability of a bank in a detiered system to be heavily dangerous, and think about a solution like I don't know. This is up to you guys. You can think about limiting the bilateral exposure of these banks, or we can. As soon as we know, we can intervene somehow. But the problem is knowing which one are they. And this one could still be the original direct member that's moving from a tier system to a D-tiered becomes even more dangerous.
Thank you, Simone and Segun. I know that we are at time. I wanted to thank you both for giving us just a little bit of a taste of the very important work that you're doing, trying to understand how that obviously applies not only to the existing systems we have in Canada, but the ones that we're building. I'm really looking forward to seeing the completion of the work that you've started, Segun, and as well, Simone, to see how we onboard the learnings that we've got from your paper in terms of the approach to tiering in Canada. So thank you very much, both of you, for the discussion today. And those of you who are interested, check out Segun and Simone on the brain dates, as well as if you want to connect with them after to dig in deeper on the data and their research methods. You can find them at Payments Canada and through their LinkedIn profile. They've got a lot of research out there that you might want to catch up on. So thank you, everyone, for your attention today. Thank you both for a very kind of mind-blowing education session for me. Thank you. And I look forward to continuing this conversation.
Thank you.
Thank you.
Thank you.